We are Pear Inc. Who are we? Pear Inc. What do? We sell office supplies with a hint of a pear smell. And our motto is our office supplies are fresh like produce.
Okay, the first step in the accounting cycle is to analyze transactions. We analyze transactions so that we know what's going on within our company. Our first transaction is done on May 16th. We received $100 cash for supplies bought by XYZ Company. Our second transaction is May 19th. The company provided $180 services on account. And finally, our third transaction is the company received $180 check for services rendered on May 19th. The second step within the accounting cycle is to journalize entries. So, our first account is May 16th. We debited cash and we credited supplies. We do this because we received cash, but our supplies account decreased. Our second journal entry is accounts receivable fees earned. We debited accounts receivable because our customer is going to hopefully in the future pay us our $180 worth. And our fees earned will of course be the $180, which we have yet to receive. And our final part of the journalizing entries is debit cash, and credit accounts receivable. We did this because our customer paid us our $180 worth of cash, and their accounts receivable account has decreased. The third part of the accounting cycle is to post T accounts, or to the ledger account. So, we create T accounts for cash, supplies, accounts receivable, and fees earned. We also involve the journal entries into the T accounts. So, our cash T account will have $100 and $180 from May 16th and May 19th. That comes up to $280. Our supplies T account will have $100 in it from May 16th. Our accounts receivable account will have $180 from May 19th and $180 from May 20th and that will cancel out because 180 minus 180 is 0. And our final T account will be fees earned from May 19th. The next part of the accounting cycle is
the fourth step in the accounting cycle is preparing the unadjusted trial balance. We use the trial balance to ensure that our debit side and our credit side equal. Pear Inc. used the ending balance from the T accounts and transferred it to the trial balance on which we determined which accounts belonged on the debit side or the credit side. If the ending balance on both sides do not equal, then we know that there is an issue regarding the T accounts or the journal transactions. The fifth step in the accounting cycle is the adjustment transactions. We use the adjustments to make sure that a balance sheet or income statement is not overstated or understated. Here's Pear Inc's example for adjustments. The first example is depreciation expense for furniture in the month of May revealed to be $25 with a salvage value of $500 and a useful life of 5 years. The first transaction that we had on May 31st, we debited depreciation expense for $25 and credited accumulated depreciation for $25.
So we'll go into a little more detail about depreciation expense. You're going to need to know more about this particular account because when you're doing your adjustments, you'll have to know how to find this amount given this equation. So whatever the cost is, say $2,000, and a salvage value of say $500 and a useful life of $5, you're going to plug all that into this equation. So the cost would be $2,000, the salvage value would be $500, and the useful life would be 5. 2,000 minus 500 is 1,500 divided by 5 equals $300. So after you find this amount, you just found your depreciation expense amount. That's how much you're going to pay on that particular asset. And when you find depreciation expense, to find your monthly depreciation expense amount, you have to divide it by 12 because of course it's 12 months in a year. So 300 divided by 12 is going to equal $25. Now when you find this amount, you're ready to do your journal entry. You're going to debit the depreciation expense to record the expense, and of course expense in normal balance is a debit. And you have to also record the accumulation of the expense that you're incurring so that you're not violating the accounting equation. So you're going to debit depreciation expense $25 and debit accumulated depreciation $25. Credit accumulated depreciation $25, sorry.
And the next example we have is 1 month of insurance coverage has expired. So the transaction reads, we debited insurance expense for $70 and credited prepaid insurance for $70. And for those of you that don't know, the word expires means that Pear Inc. used 1 month of insurance coverage. Moving on, the 6th step is preparing the adjusted trial balance. So we use the original information from the trial balance and include the recent adjustments made, and that will determine our ending trial balance.
Step 7 is the financial statements. You're going to start with the income statement, which involves revenues and expenses. You must subtract the revenues and expenses, and that will give you the net income. And the income statement is a period of time. Then you will move on to the statement of retained earnings. The statement of retained earnings begins with the beginning of retained earnings. Then you would add the net income that you got from the income statement, which is the revenues minus the expenses, and then you would less the dividends, and then that will give you the ending retained earnings. And lastly, you will go on to the balance sheet. The balance sheet is included. The balance sheet gives you the accounting equation, which is assets equals liabilities plus equity. Assets are what we own, liabilities are what we owe, and equity is the owner's claim on a company's asset. And the balance sheet is a point in time.
Okay, so the 8th step of the accounting cycle, the closing process. It's a very important step. It's at the end of the Pear Inc.'s accounting period. When working with the closing process, there are 3 steps that should be followed in order to be successful. First, you have to identify the accounts you are closing. Second, you must record and post those closing entries. Finally, you must prepare the closing trial balance. When doing the closing process, there's 4 steps in closing all the closing accounts. First, you have to debit your revenue amount and credit that to income summary. You do this by debiting whatever revenue account you have, and that total is, you credit that to income summary to show the transfer of cash that you're closing from the revenue accounts and transferring that to the income summary account, the temporary income summary account. Then you would debit your income summary the same amount you would credit for all your expense accounts. It does the same thing as the revenues. You're closing all the expenses and you're transferring that over to the temporary income summary account. Third, you would close that income summary account to retained earnings to account for all the revenues and expenses that won't be on the balance sheet because those are all temporary accounts. So you're going to debit income summary whatever the amount was that you debited for the revenue and credited for the expenses. You're going to subtract these by the revenue amount minus the debit amount to get the credit amount of $2,915. And finally, you'll close dividends to retained earnings as the final temporary account. Dividends was $2,000. We're going to debit this to retained earnings to account for the transfer that we're closing with the dividends. And once we do all this, we get a final retained earnings amount of $75,915.
Okay, so last but not least, we have the 9th step, which is the post-closing trial balance. This step includes all of the permanent accounts. And once you include all of your permanent accounts, you will finally get the ending balance.
And that's all, folks.
Third, pause it. Oh, okay, so participation. Okay, so Taylor.
The balance, step 7. Step 7 is the step that,
Yep. The step.
Step 7, what is the balance sheet, right? Are you guys sure?
The balance sheet.
It's the financial.
It's a financial statements, but the balance sheet is important for.
The financials.
Yeah.
Okay, I'm gonna get on this thing.
Alright. You ready?
I can't wait.
Ready?
Okay. We'll go this way. Okay. Oh wait. I'm gonna put this down.
Alright. Ready?
Okay.
Okay. Are you ready?
Yes.
Wait, what are you doing? Wait, I thought you were doing the beat. Are you doing the beat?
Yeah, I'll do the beat too.
Alright, you ready?
Oh, yes, I can.
Cause I can't do it. I'm gonna be real.
1, 2, 3.
Practice it.